I'm going to, all right, we're going to get started here. It's 3:30, so let's see, Corporate Central Monthly Market Monitor. My name's Wade Cooper. I'll be hosting it today. Um, while people are still filing in, I will show my next slide, which is the disclosures. This is because I'm a registered representative and have to show these things. I'm not going to be talking a lot about um, securities. I'm going to be talking about some treasuries, market in general, um, but mostly I'm going to be talking about how I do this a little bit different. I like to take what's going on and apply it to credit unions. So a lot of Callahan slides will be uh, the second quarter data is almost complete through Callahan, so it's close enough. Not all 4,800 credit unions have reported yet, or it hasn't gotten the data hasn't gotten to Callahan yet, but that's okay. Um, so let's start with yield curve. Still inverted. Um, no big shock here. Um, you can see these are U.S. Treasury rates. Um, obviously, this is our um, the big hike, all the hiking that was done. Our ALM models are plus and minus 300, and we had a nice over 500 basis point hike here in a matter of year and a half or so. But again, inverted. There was talk. I remember when this first happened, the the 2 year fell below the Fed funds, and or excuse me, the 2 year fell below the 10 year. So the 10 and the 2, that's when people start getting excited about stuff. And I remember Janet Yellen saying something like, well, we don't, start paying attention until the 3 month gets higher than the 10 year. Well, that happened too. So um, I've done a few of these since it's been inverted. And I said, since it happened, that I'm going to show this slide every until we either have a recession or the curve goes back to normal. Um, and it's not that I'm rooting for a recession. Nobody wants a recession. It's just part of the economic cycle. Um, there's peaks and troughs and all that good stuff. But you can see every day we don't have a recession, we're breaking a record. You can see on the right hand side here. This is the lags from yield curve inversions to recessions. There's a thought out there that anytime there's an inversion, it's a leading indicator of a recession to come. And so you can see on the right hand side here, these are the months, these are the days, these are the months um, from inversion to recession. And they down here pre 1985, the average is 8.2. I don't know what 1985 is the magical number, but it is. Averages all years is 9.8, and then post 1985, 11.5 months between inversion to recession. Now we inverted on 10/26/22, so we are 22 months. We're almost double of the average, and we're beating the record by almost 6 months. Um, yeah, we're at 22 months. Um, so we'll see. It'll be interesting to see what they say about um, maybe the recession doesn't happen. The soft landing. Maybe the recession doesn't happen um, before the yield curve normalizes. So I don't know what the data point means when that happens. But somebody will make something up, I'm sure. So this is normalcy, a normal curve where, well, I guess I'm presenting, so it goes this way, right? You can see the 10 years at the top. And by the way, I didn't mention, so of course, PPI came out yesterday, CPI came out this morning. Inflation is cooling. It's still at 2.9, I believe. And so now there's a lot of talk of uh, rate cuts. So we're 525, and there's I've heard 100 basis points. The market's calling for 100 basis points by December. Remember, at the beginning of the year, they were talking 5 to 6 cuts. Um, so if it's, I think there's 3 meetings. So one of those would have to be a 50 basis point cut if they did it September, October, then December meetings. Um, so, I mean, we'll see what they do. No, it's everybody thinks that's going to happen. That's where I shouldn't say everybody, um, but what I find interesting is that we're still at almost 3%. The target is 2%. Now, of course, the rate of inflation has gone down, meaning, do we have to still be at 525 to keep pushing it down when it's starting to go down now? So is it time to start cutting now? Um, I think that's kind of the prevailing thought. Um, we'll see how it shakes out. I'm certainly not going to predict what's going to happen, but I just find it interesting that it's still 2.9. We haven't hit their 2% mark, but we're talking about cuts. But again, that's probably because there is some deflationary things going on when you really crunch into the numbers. But I wanted to show this slide because you can see the 10-year at the top. That's the 10-year Treasury. The yield is 383, and then if you go down, you see the 3-month and then the 2-year. So the 10 and 2s, that's, again, we hear that a lot. That's pretty close. Only 13 basis points apart. So that's interesting because if now it would seem to me that the 10-year would still go down and the 2-year would have to go down at a faster rate in order for that in order for the 10 to get above the 2. But on the short end, and so I think the market is telling us, okay, it's coming. On the short end, of course, if we're still sitting at 525 in the um, Fed funds, it's going to have to come down a lot for I mean, look at the 3-month. So what Janet Yellen said, the 3-month and the 10-year, that's a big spread. That's 100, uh, 120, almost 140. So that's a big spread. So the Fed funds have to come down in order for that to start normalizing. But this is the 10-year or excuse me, this is the Treasury market. The folks, not everybody buys Treasuries, but this is a good way to watch and see what's going to happen soon. But a lot of people buy CDs. So I brought this up, the rate comparison from May of 2024. The 1-year, the top rate was at 525. The average, so that you can see the average of the top 5 rates, is 517. And then the 5-year, the top rate 3 months ago was 470, and the average was 460. Now, fast forward 3 months to this morning when this came out, we have the 1-year top rate 481. So that's almost 45 basis points. But then the top five rates, a little bit more drastic. It's 49 basis points um, from the average here to here. And then the 5 year, again, same story as the Treasury market, but we were looking at 470 for the top rate, average of 460 for the average. 5 year this morning, so 3 months later, we're at 405. So the top rate went down 65 basis points in 3 months, and then the average is even more. That's 80, almost 90 basis points. Then it went down 89. So the market is signaling something here, and we'll see what the Fed does next month. But it might, I don't know. If you think things are going to keep going down, locking in right now wouldn't be a bad idea. I'm not here to make bets one way or another. I'm not gambling with your money. But if you think this is going to continue, then locking in might be a good idea. Let's look at some loans really quick. This is loan composition. It's all credit unions. So I'm going to be using all credit unions for all these slides. And, the large credit unions, this is going to be skewed because most of the large credit unions, well, they just skew the numbers. So, for example, not every credit union, especially a small one, has commercial lending. And, for all credit unions, the loan portfolio is 10%. So that's not going to look the same for everybody. But I just wanted the reason I even brought this out was the, residential first mortgage, 36%. We have used auto at 20%, new auto at 10%. This is, so let's just call it 30% of the car market, or the portfolios, autos, and first mortgage 36. So we're 66, but well, only 2/3 of our portfolio is in the bread and butter, first mortgages and autos. I did see in the CPI report that both used and new autos have those numbers. The prices are coming down on those. If you're a buyer, I guess that's good news. My concern on that is for the used autos, if those prices keep coming down and you have a lot of that on your books, that means those values are coming down as well. If you need to start collecting on those with a tow truck, there's those vehicles will be less valuable than which is usually the case anyway, but it might be more drastic. So I'm a former regulator. I like to look at the ratios. Here's the net worth ratio. Nothing too crazy in this slide, but it's the king of ratios is net worth ratio. So, it would you might not be at 11.4%, right? Pre-pandemic. Here's fourth quarter of 19. And you're going to see this on all the slides. The pandemic just screws everything up. So, but we fell all the way down to first quarter of 2020. The ratio really dropped. So in a little over a year and 5 quarters, we went down from 11.4 down to just above 10. So let's call it a 10% drop. So and not everybody's going to be at 11.4, and not everybody, hopefully the regulators didn't beat you up too much if you went below 10 during the pandemic. but your numbers should probably look something like this. Maybe not the exact, the chart should look the same, I should say, or similar to where it kind of craters here and then comes back up. And we're still setting, I mean, pre-pandemic levels. I know these seem kind of elevated, but I mean, what we're above 11% in the second quarter. That's pretty good. If you're, this isn't for everybody, and I get that. I'm not saying everybody should be at 11%. If you can run your credit union at 9% and make money and have low delinquency, then good for you, you know. I wish all the regulators thought that way. I'm not speaking for all regulators, by the way, or all examiners. Um, this is a little concerning. ROA. I always like to look at net worth, ROA, then delinquency, which is the next slide. But you can see similar story here. We're doing fine. Kind of rose right before the pandemic, and then boom, um, COVID hits. The coronavirus screws a lot of things up, and then we have a bunch of stimulus. So things spike up, which actually skews the numbers too. We go from cratering to stimulus money that comes back up, and we kind of normalize there a little bit, and then but this is the concerning part. Um, we're below zero point 0.7 on ROA industry wide, and that's like even it's prior to the pandemic, even over here, we weren't that low. So this is a little concerning. This being soft right here. I don't care for that. Um, Next one's delinquency. This one's a little concerning too. And again, I am not sky is falling, chicken little, things are horrible. I'm just these are the numbers that are out there. You can see the trend line is 10 years of delinquency. So you can see the trend line what was going like in our favor. It always spikes in the fourth quarter, spike, fourth quarter. But the trend line's going this way. And of course, all the stimulus money comes in, and everybody pays off. Nobody's losing money. Everything's great. Well, not great. I shouldn't say that. It was a terrible time. But um, so you can see the spike here, fourth quarter, and then this is the really big spike. This trend line is not good. So we're gradually going down, we crater, and then we're way beyond. It's almost like a rubber band, right? Or go, it gets stretched, and then now it's popping back this way. Delinquency usually falls in the first quarter, and then starts gradually coming back up all year. So this is the second quarter number, which is equal to the fourth quarter, or just below it, which tells me, um, you know, we might, as we move on, it's going to be third and fourth quarter. Hopefully, industry wide, we don't get above. And again, this is still 0.85, 0.83, I think was the number. Not terrible. Everybody, the magic number is one. Keep things below one, and usually good. All right, but just the rate that it popped up is a little concerning. So keep an eye on it. And again, delinquency. This is industry wide, so it's going to be kind of a macro level. Um, what's happening in the market. But just from a more local level where you're at, well, let's start with internal. Internally, um, delinquency, if there's delinquency starts going up, the first thing we'll start asking about is, underwriting and collections. So poor underwriting, bad collections can lead to high delinquency. then maybe it could be a SEG, it could be a big company in the county, big company in your town. I don't know if you recently saw, it was earlier this week, I saw it was in Perry, Iowa, that a Tyson Foods plant shut down, and 25% of the workers in Perry, Iowa are now unemployed because that uh, plant shut down. 25%. So I don't know if there's any credit unions in Perry, Iowa, but I wouldn't want to be holding a lot of paper there. Now, hopefully they all find jobs and everything. They knew it was coming, so hopefully some people get back to work there. But again, that's just an example um, of a not a macro but more localized thing that could happen um, in to a financial institution. But anyway, it's something to keep an eye on. Checking my time here. I'm going way slower than I thought I would, so I apologize if I go a couple minutes over. Liquidity's coming back. So short-term liquidity as a percentage of total investments, including cash. So I guess you can see where it spikes, and this was this was the stimulus money coming in. Like I said, all these graphs, right in first quarter of 2020 is when things start getting messed up. But rates, or when the stimulus money kind of stopped flowing and rates were starting to go up at this point, and there were credit unions that were lending out a lot of money at this point. They were running out of money. Got to this, we bottomed out here in 22, and then it's coming back pretty good clip too. So we're at pre-pandemic levels now with liquidity. My guess, and this is anecdotally because I speak with a lot of credit unions, a lot of maturities that they have coming in that they're not reinvesting long term. They got a little spooked by this, want to keep things back a little bit, which kind of goes against what I said earlier about locking in if you think things are going to keep dropping. But it is I understand why once they ran out of money and the money started coming back in, why they would want to keep a little cushion back. Saw a lot of that. So loan to shares, again, the big skew here, but it's nice. This is almost inverse of the liquidity, right? But this makes sense. All the money came in during the pandemic that goes to your denominator, all your shares, all that money, all the stimulus money goes into your shares, making loans, but not enough to keep up with the denominator. So it looks worse than it really is. And a lot of lending picked up after that, and the denominator started getting a little lower. But here we are. And again, not everybody in Wisconsin is a high loan to share state, but we have a lot of other credit unions and even on this call that are not in Wisconsin and don't have high loan to share. And that's, there's again nothing wrong with that. This is just industry wide, you can see that we've come back. Your individual chart might have a similar graph, just different numbers. But the 84, as long as you could be running at 50% loan to share, as long as again, good net worth, making money, ROA, low delinquency. Regulator might get on you about, oh, hey, you need to do some more loans, but in some places it's just difficult. So next graph, this one this one is, I thought this one was very interesting because, and it's timely and it's something to keep an eye on. You can see on so the red is the cost of funds, credit unions, and that's going to be on the left-hand side. And then the market rates are we have Fed funds 3 month, 3 year, and that's going to be over here to the right. Um, our cost of funds lags behind the market rates. So you can see the market rates start going up here and they kind of top out and then start going down. Well, our cost of funds didn't start raising till about here. And then this is where the market topped out. We didn't top out till here to start going down. And then the same thing happened with the Fed funds shot up. So you can see they started going up here, and we didn't start going up till a little while later for our cost of funds. Now, the reason I bring this up is because if there are cuts and rates start going down, that's going to squeeze your margins. If your cost of funds are still high and rates start going down, mortgages are going to start going down. I just saw that even with this little bump that we've had, not even a cut, the refis are really starting to pick up, and it's not even we're not at 3% loans like we were a couple of years ago. It's still, I mean, it's still above. I don't even know what it was this morning, but point being, it's only come down a little bit, and the refis are already starting. So, so as they come down more, the refis pick up, or you start making more mortgages. If your cost of funds are still high, it's going to squeeze your margins. So keep an eye on that. Here we are up here. So next one, this was a happy slide, loan yields versus market rate. So for a little while, things got hairy. I mean, so the yield on loans is the red line, then the market rate, 6-month Treasury, 3-year, 20-year. And really the 3 years one, this is where it started getting concerning, because our loan rates were at one point, this is a longer time, our loan rates were below the 3-year. It doesn't show up on here, but it happened. And that was a little concerning because people weren't paying attention to the rates. Now, it's difficult to raise your loans 100 basis points when the market was raising them that much. But the good news is right now we're above all the market rates. So we have margins. That's good. Because people, will take their, talk about cost of funds, and if they're not getting good rates at their credit union, they might pull out as far as their yields go. So we got to make sure that we keep them around, which leads me into share growth. We didn't have, so I have another graph that I'm going to show you here in a second because it's kind of a jumbled mess, but what sticks out is the orange line. So we got regular shares in red and share certificates in orange. So it's kind of a jumbled mess, everything here. And then you see a pop in share certificates in 19. We go down, and then another big pop here between 22 and 23. And at the same time, you can see at the red line, it's almost inverse, um, are going down. My guess is and again, I talked to a lot of credit unions who would say, we need to attract some more funds, and they'd run CD specials, and then instead of attracting new funds, they were kind of cannibalizing their own shares. So people took their these really great certificate rates and take it out of their uh, share account and put it into the share certificate. So that's my guess as to what happened. Um, this is the bar graph, little um, little cleaner. The orange really kind of sticks out in this one. Um, that's the certificates, and then the regular shares. It's a little hard to see with the um, between the red and the blue, but you can you can see how they dipped. Um, so I would, if this is something that happened to you, it might be worth a core deposit study through this, a non-maturity deposit study, um, just because the way we were so, you can really see it here. We were so kind of consistent all the way through here, and then of course 2020 happens, and all the stimulus money comes in, and it starts flowing out, and then we need money, so we have the certificate special. So there's a lot of core deposit, even ALM, significance to all of this too. So think about it. I am just over my 30 minutes. I'm gonna end here. Thank you very much. I appreciate everything. Give me a call if you have any questions or concerns or want to chat about anything. You can always email me, wade.cooper@corpsu.com. Again, thank you, and I'm going to stop there.